Welcome to the Yorkshire Shadow MPC, a partnership between Clive Owen LLP and the York Press. The big news is the inflation figures released last week. Official figures show that the increase in the cost of living, as measured by the Consumer Prices Index, hit 3.2% in the year to August. Higher prices in restaurants and for recreation and food were behind the spike, up from 2% the previous month. I'll be asking if this is enough to warrant an interest rate increase now, or are other factors in play, for example the end of furlough and the social care national insurance increase. Finally, we will have a show of hands at the Shadow MPC members vote for an increase or a decrease, or would they prefer rates to remain at 0.1%. Firstly, I'm going to hand over to our sponsor Rob Whitehead from Clive Owen LLP.
Rob Whitehead from Clive Owen Chartered Accountants in York. We're experiencing still high demand for our services, but our clients very mixed bag again out there. A lot of businesses still seeing a lot of demand and obviously suffering from inflationary pressures in terms of supply chain and purchases, overheads, all going up, shortages in the supply chain as well, causing issues in meeting that demand. So there is a lot of pressure on businesses out there, and like you mentioned earlier, the furlough scheme is due to end very soon, and the impact of that is still quite uncertain. But whether now's the time to be starting to increase interest rates, I'm not 100% sure on that, although it would clearly send a signal to the market if interest rates were increased. But I think even if they were, it would only be a very small increase. So yeah, that's my thoughts. Thank you.
That's great. Thanks, Rob. Some mention of the supply chain there. With that in mind, can we go to Richard next? Richard Peake, Helmsley Group.
Yeah, hi, everyone. We've when I was on the last meeting of the board, I think we were reporting a significant increase in terms of buyers for the houses that our projects were involved with. And that to some extent was due to the stamp duty changes that were going on at the time. But to be fair, it is still there. We're seeing good demand. Certainly a lot of money out there looking to invest in properties. The biggest thing from an inflationary point of view we're seeing at the moment is a massive pressure on build costs. We've got borrowers who we lend money to, and also on our own projects where for certain types of materials they can be 35-40% up from where they were. So when we used to be expecting to build a house for, let's say, 125, 130 pound a square foot, it's getting close to 200 pound a foot now, which is quite amazing to see. Now whether that's going to come down in the fullness of time, we don't know. In fairness, that's the gamble that ourselves and a lot of companies are going to have to take. We're sat on sort of up and ready schemes at the moment, and we genuinely are having the discussion in house at the moment as to do we sit and wait and see what happens. Best example I can give is we just had a project that we were looking to start on where independent quantity surveyors had previously suggested a build cost of, let's say, £3.5 million. We've had the tenders come back in, and they've come back in at 5 on average. So, we're okay because we bought well. But if other developers around the country are seeing that, that's going to see some project or question the viability of them from that side. So that will inevitably have a delay in terms of the supply to bits and pieces. The other thing, just before sort of finishing, is that we are still seeing the effects of business in general trying to get used to sort of this hybrid working with staff now, whether it's 3 days in the office, 2 days, or whatever it is. But certainly, a number of the banks and the mortgage providers that obviously we liaise with, that they are seeing an impact in terms of turnaround of bits and pieces. Councils, for instance, and the searches that solicitors have to put into them, there's a massive delay in certain areas of the country on that side of things. We again, just as a quick example, we have a scheme where I know a sale was agreed at the beginning of August, and the search results won't be back from the council until at the very earliest 6th of October. So the buyer and the vendor, they lose 3 months in terms of the process. So there's things that are slipping all the time. Trying to bring that back on board, I think, is one of the biggest pressures we have at the moment.
Yeah. Absolutely, and will local authorities and the rest of the civil service return to their offices now the work from home orders have ceased? So, do you think then, in your view, that the end of the stamp duty holiday, which is any day now, will not impact the property boom, the housing market boom, the property increases? Do you think that will continue post stamp duty holiday?
I do, to be fair. Yeah, I think it may differ in certain sectors, whether it's the sort of the lower value or the higher value, but certainly at the high end, which is a lot of the stuff that we sort of provide. Then the buyers are still going to be there, and frankly, just because stamp duty is finishing now, because of the delays I was just talking about in terms of searches, you can't agree a deal and buy a house the next day. It just doesn't happen like that. So these deals were agreed back in June time anyway. So people are now thinking, right, well, we're in September. We'd be cross our fingers and hope we're in for Christmas, really. The market will still move forward. I think the stamp duty holiday was a massive impetus and certainly helped. But there was a pent-up demand there anyway. I think the profile of buyers has been pushing towards moving out into more countryside, rural settings if they can. A little bit of garden, home office, rather than sort of a big push for apartments in the city centre, which we would shy away from at the moment.
Absolutely. All right. Thanks, Richard. That's very interesting. Can we go to Gary Smith next, please, from Tilney Financial Planning? Gary.
Hi, good afternoon. We're still having the same issues with the clients that we deal with. We have those who are sitting on cash. Interest rates remain relatively, historically low, and they are looking for higher rates of interest without taking any risk. And unfortunately, there isn't a magic solution at the moment, and it's unlikely to change in the short term. This has led to further discussions as people who are potentially cash rich at the moment look to invest to try and outperform inflation. And we're certainly seeing an increased demand for pension contributions, ISA contributions to be made. That might be influenced by the government's decision to raise taxes and break a manifesto pledge, where the autumn statement is due in a few weeks now, and whether or not people are concerned that pension allowances and ISA allowances might be reduced and people are advancing their funding this year is something that we are seeing. But from an investment management side of things, we have been trying to structure our portfolios to look to invest in assets that perform well in a low interest, high inflation environment. And it's something we've been looking at for a number of months now. My view is that inflation hasn't peaked. It will continue to rise, predominantly for supply chain issues. The news about the gas supply and the increased cost in wholesale gas supply will no doubt add further to that. And anecdotally, clients we deal with who manage their own businesses, they've probably suffered the increase in inflation, increased costs so far, and that's been a hit on their balance sheet. But unfortunately, they're going to have to start passing that on to consumers. So that's another further reason why we suspect inflation will continue to rise in the short term. But this isn't a wage increase demand that's leading to inflation. It's a supply chain issue. It's the cost of goods and services, all impacted by the pandemic. And in my personal view, I do not feel that a rise in interest rates will temper that inflation in the short term, because it's not as a result of people, having significant cash in their pockets and being able to spend. It's more an issue in supply chain, and there is a demand there, but when demand exceeds supply, prices go up. And as we come to the end of the furlough scheme and the government intervention in supporting businesses, in the next 3 to 6 months, we could start to see an increase in redundancies as if the furlough scheme comes to an end, which could temper spending, and businesses that potentially would have failed without government support may fail. And again, that may lead to a slowdown in the economy. So from my perspective, I don't feel that an interest rate rise would necessarily solve the current issues.
Yeah, interesting points. The furlough scheme is coming to an end. About 1 million people still on furlough, but of course there are currently 1 million jobs being advertised in the UK. So probably not simply a case of switching, but there are jobs out there. Fantastic, thanks for that, Gary. Can we move to David Broadbent next, please? Begbie's trainer.
Yeah, good morning, everyone. Thank you again for asking me to appear on the panel. Just picking up from your last speaker, actually, as an insolvency practitioner, I did a seminar, in fact 2 seminars last couple of weeks, and within that we were explaining how the world of insolvency is very quiet at the moment. All of the cash that the government have been throwing into the economy has effectively put a very large plaster over everything, and it's stopped everybody from having to make any difficult decisions. You just mentioned then there's about 1 million people still on furlough. I think it's slightly north of that number, and as you've correctly pointed out as well, there are the jobs out there, but I just don't think that the skill sets of the people coming off are going to be the type of people that will be applying for those jobs. So I suspect towards the back end of this year, you are going to see an increase in the number of insolvencies. It's going to have to happen at some point. The Revenue and Customs as well have had an amnesty in relation to the collection of taxes, which it's also going to have to come to an end, and they will have to start their collection process. So all of this effectively is unfortunately heading us towards quite a not nice period of time for the next 6 to 9 months. And I think increasing interest rates will simply not be the correct decision. People are or have been very reliant on the funds that have been readily available in the last 18 months. However, people haven't really been in a position where they've had to pay anything back. So I think any sort of slight increase in the interest rates just will not help, because people will be desperate to borrow in the next 6 months, certainly to get themselves over the quiet period of time that people are going to be coming up to in most sectors in the next 3 to 4 months. But yes, I think increasing interest rates, probably not. I think the government are going to have to look at some other way of trying to get people to spend their cash. And as the previous speakers have both mentioned, I think the problem that we've got at the moment is demand is so high, but there just isn't the ability out there to service it. So costs will continue to increase.
All right, thank you. Difficult times ahead. Jill, do you agree?
Yeah, I agree that with the rest of the panel so far. I don't think they can increase interest rates at the moment. Here at GSM, we're in manufacturing. We've been really hit with issues with the supply chain insofar that we've had to overstock to take advantage of price rates to try and bring the costs of our raw materials down. But we're also really struggling, and I think our main concern at the moment is recruitment. We cannot recruit unskilled or semi-skilled workers. We've had a lot of people leave due to Brexit, and actually due to the government immigration rules now, unless somebody's earning £25,000, people are not coming back to the country. And so we can't sort of scale the minimum wage level of jobs. So we're finding that people are dictating that we're paying well and above. We're in a competitive industry. We're trying to compete against the hospitality sector, and we're having to pay higher and higher wage bill. So that's also having an impact on our business. GSM are in a fortunate position. We don't have debts, so we don't have to pay interest on our debts, but as a result, we're not also getting interest on our cash that we're holding. So we're now looking at alternative ways of spending that cash. We're looking at investments in our fixed asset. We're looking at more automation to try and help us with the labour or the short labour supply that we're having at the moment. And I just don't feel that the government, with all their borrowing over the pandemic, could afford to pay the extra interest and all the guilds that they've borrowed to cope with the pandemic.
Absolutely. Would the government ever willingly raise its own tax bill? Probably not.
No.
Its own debt bill, I should say. Fantastic. Thanks, Jill. Harvey or Chris? Can we come to you
Hi
next?
there, good afternoon. Thanks again for the invite. Yeah, I've kind of changed my view on inflation. I think I voted for, or should I say interest rates? I think I voted for an increase in interest rates last time we had this vote. But I think we've seen quite, dystopic increases within costs. And as insurance brokers, we act for a whole range, quite an eclectic range of clients. And the effect of the cost push inflation is having a massive effect upon businesses, and I don't think increasing the interest rate would have a harmful effect upon those businesses. So be it haulage where their wage bills going through the roof, be it in hospitality, again wage bills going through the roof, be it in construction. I think the Helmsley Group have touched on it just then. I think, raw materials going up by 30, 40, 50% at times is quite unprecedented times. It's extraordinary, really, which I think is reflected by this record increase in the inflation rate in the last month. So, but I don't think the interest rates or the increase in interest rates would have a positive effect. I think quite the opposite. I think it would be deleterious for us to even think about increasing those rates.
All right, excellent. Thank you very much, Harvey. Steve Lowe next, please.
Hi everyone. Well, I look after the York Press and Local IQ, which is all about marketing for customers. Bit of a perfect storm, really, in a negative way, and you've all touched on it. The recruitment market, that yes, there's lots of jobs, but no one's moving. Those they're frightened to move for fear that lockdown and it's last in, first out, so they're staying where they are. So that's driving up salary bills for people to be attracted to move, which Jill mentioned. The students have worked from home for such a long time that they haven't filled the hospitality market in terms of people as well. There's pent-up demand on spend for consumers to go out, and Rob started at the beginning about the supply chain. We're doing some work at the moment. There's 100,000 lorry drivers short in the UK to move goods and services around, which is driving up prices because you make the goods but you can't move it, and so there's lots going on without us pushing up interest rates in my view, and I think we have to encourage people to continue to feel confident in spending where they can, and I think the move to put interest rates up we might put the blockers on people spending and start thinking that the mortgage rates are going to go up, and therefore would put a fear into them going out and spending on the high street, which I think will have a real negative impact, especially when goods and services are being challenged to get out there.
Interesting stuff. Thanks, Steve. Steve mentioned students there. Bob from York Business School, what do you think?
It's my first time here, and it's nice to see you all. I've been the classic long COVID and chronic fatigue syndrome, so I've not been able to join you previously, so I do apologise for that. Gloomy picture being painted by just about everyone so far, and it is a gloomy picture, there's no doubt about that. Not surprising in many ways that inflation's gone up. because of all the factors we've talked about and all the exogenous shocks there's been on the economy. Inflation almost certainly, it's not peaked at the moment. I can only see it going up again in the next few months towards the end of the year. I agree with just about everything that's been said in terms of interest rates. I don't think it's time for an interest rate at all. I think we need confidence in the economy, and an increase in interest rates would impact on that. But it's when it gets to a specific level, and we don't know where that is at the moment. But I don't think it's certainly not the case. Historically, inflation rate is low at the moment. So we're used to seeing it in the last decade or so being much lower than it is at the moment. I think it's a time for holding our ground, keeping things where they are, and seeing how this pans out. But it's a very uncomfortable situation. Of that, there is no doubt at all. Difficult times.
Absolutely. Difficult times indeed. And as you say, inflation is higher than it has been, but historically, as yet, still reasonably low in terms of the historic precedent. Great. Well, I think everybody's contributed now. Some fantastic contributions, albeit them not terribly positive, and giving quite possibly, although we remain hopeful, a realistic outlook for the next 12 months and some gloomy times ahead economically, perhaps. But now I think it's time to. I think I know what the outcome is going to be. But I think we'll move to a vote. Can I start by asking for a show of hands of anybody who would like to increase interest rates this time? Nobody for an increase. It's unanimous. And what about a cut in interest rates? Very difficult to cut them from 0.1%, but is anybody for a cut in interest rates? Nobody's for a cut. And finally, anybody who would like them to stay as they currently are at 0.1%. I think we have a unanimous vote. And I think that is probably, given the instability and the spectre of rising inflation over the next quarter and who knows how long, I think that's probably a prudent solution. Well, thank you very much, everybody, for joining us. We've had some very, very interesting, insightful contributions, and we do hope that you will join us next time. Have a good rest of the day.